Warren Buffett once quipped, "I try to invest in businesses that are so wonderful that an idiot can run them, because sooner or later one will." Hello and welcome everyone to my channel, The Quality Investor. This is a place for passionate investors that enjoy simplicity. Our focus is buying great businesses and holding them forever. Of course, we want to purchase at a fair price, and sometimes the market offers up a lovely discount for us. Fundamentals are the name of the game here, and we like to understand what the future economics of the business might be. Please, if you haven't done so already, hit that like button for this amazing video and subscribe to the channel. It really helps us out and lets me know that you want to be a part of this community of quality investors. Also, hit that notification bell so you can know right away when I post more great content just like this. Today, I'm going to rank the 5 worst stocks out of the 30 Dow Jones Industrial Average stocks from 26 to 30. These are stocks that might make strong turnarounds in the future, but I'd like to see a few quarters of renewed growth before even adding them to my watch list. There's a bit of negativity for everyone here, from bad management and industry disruption to no growth in sight to brazen theft rings. Let's dive in. Our first stock on this list, the 5th worst in the Dow Jones, or the 26th best of the Dow, is Nike. Nike is a great company with a great product. However, the last few years has seen a lack of conviction in the law enforcement world, causing a lot of theft issues at Nike, even to the point where they are shutting down stores. As you can see, Nike officially abandons efforts to reopen its Northeast Portland community store. The store has been closed since last year due to theft problems. At one point, Nike requested off-duty police officers to provide security, but the mayor said no. Another article states, "More arrests after brazen flash mob robbery at East LA Nike." As you can see, Nike has been dealing with some problems with theft, and that has definitely hit their margins, and that's reflected in their returns, down 18% year to date and down 8% annualized over the last 3 years. You can see Nike's decline on the chart here in the last 3 years. They peaked a little bit right before 2022 began, but they're down nonetheless through today. You can see it reflected as well, down in ROIC, down on return on assets. Their margins have been slightly declining the last 10 years. Operating margin down, net margin down. And for these reasons, Nike is my 5th worst stock of the Dow Jones Industrial. The 4th worst stock of the Dow Jones Industrial is none other than very iconic entertainment company, Disney. Warren Buffett once quipped, "I try to invest in businesses that are so wonderful that an idiot can run them, because sooner or later one will." Disney is putting that maxim to the test. Disney used to turn everything it touched into gold. They have some of the greatest IP ever created. Recently, however, it's been one problem after another. Park attendance, the real revenue driver for Disney, is down. They've had flop after flop at the box office. Their properties like ESPN are not the cash cows they once were. And while the S&P 500 has returned a robust 49%, the last 5 years, Disney has lost 32% of shareholder capital. Disney lacks easy fixes to its numerous challenges, analyst warns. Although the sale of TV assets would make sense strategically for Disney, the question is, who would buy them? A gimme credit analyst says. Similarly, Novacell said that Disney faces a tough road ahead as it strives for streaming profitability by the end of fiscal 2024. Disney presumably has leveraged its content as the main driver for subscriber growth, spending some $30 billion on programming last year. But if a company pulls back on that spending, it threatens to hurt subscriber momentum, in his view. Disney's board of directors has tabbed Iger to stick around as CEO for 2 years longer than initially planned as the company bangs out a succession strategy. And while Iger's return to Disney last year was lauded by many, Novacell highlighted that some of the company's current problems are of his making. Novacell expressed concerns that Disney's free cash flow will face constraints as a result of hefty capital expenditures associated with the parks segment and the likelihood that the dividend is reinstated soon. Plus, Disney is likely to pay at least $9 billion to buy out Comcast Corp's 1/3 stake in Hulu, though the cost could be possibly much more. That Hulu put is an intriguing notion. Just as that article mentioned, $9 billion is just the floor for the Hulu put, and it could be a lot higher. They're in the process of negotiating it right now, and it should be wrapped up by early 2024. Inside the structure of Disney's and Comcast's complicated Hulu deal, and why it's pivotal to Bob Iger's turnaround plan. And remember, I mentioned the turnarounds at the beginning of this video. Peter Lynch, the legendary Fidelity investment manager, he has a category called turnarounds, and that's how I view Disney. It's a turnaround. They're going to turn it around. It's just going to take some time. I quickly wanted to point out in this article, due to Hulu's current virtually break-even profit status, analysts mostly agree it's unlikely Disney will pay much over $10 billion. For example, Peter Supine of Wolf Research has an estimate of $9 to $13 billion. Even at $9 to $13 billion, that's an important number because let's look at the cash Disney currently has on their balance sheet. Disney currently has $11.4 billion of cash on their balance sheet. Even if it's at the low end on the $9 billion side of that for the Hulu put, Disney's not going to use all of their cash to fund that deal. They're going to have to issue corporate bonds or something of that nature because they're certainly not going to raise capital by issuing shares. Disney, however, is suffering from a management problem. After Bobby Iger is gone, I truly hope he is replaced by a no-nonsense CEO that can turn this ship around because Disney is sitting on incredibly valuable assets that are begging to realize their true potential to entertain the masses. The third worst stock of the Dow Jones Industrial is 3M. 3M is a massive conglomerate that is best known for Post-it notes. However, they have been facing serious legal battles over the last few years, and it doesn't look like those legal battles are ending anytime soon. In the last year to date, they have a 22.7% loss in share price, and over the last 3 years, they've lost 14% of shareholder capital per year. Their share price chart is just one big divergence from the S&P 500 in the downward direction. You can see here on their important metrics, they're pretty much either flat or down over the last 10 years. Margins especially are down, and we never like to see decreasing margins. On the legal front, 3M faces more legal headaches after $6 billion earplug settlement. So they just settled that massive earplug tort brought by the U.S. Army for $6 billion. They're slated to start paying that October of 2025 over 5 years. It's important to note that 3M's trailing 12 free cash flow is only $4.4 billion. So management will need to make tough decisions on how to allocate that free cash flow in order to pay that settlement. And that doesn't include the company is also awaiting approval for its $10.3 billion settlement over so-called forever chemicals. While news of the settlement relieves one big legal overhang, 3M is still waiting approval of its $10.3 billion settlement with water utilities over drinking water contaminated with substances known as forever chemicals. That settlement, which is facing pushback from more than 20 states, only covers a subset of liabilities and does not include a growing list of states that have sued 3M, nor does it include personal injury claims. Capstone estimates 3M's total PFAS liability risk is nearly $30 billion beyond existing settlements. So if that estimate bears out, that means $40 billion additional dollars that 3M will need to pay in settlements for its lawsuits. 3M's dividend is in serious trouble, and much of its free cash flow will also be diverted away from retained earnings as it pays out its legal obligations. 3M's reign as a dividend king is in serious doubt. Long live the king. The second worst stock in the Dow Jones Industrial Average is Verizon. Verizon doesn't have the theft or legal troubles of the others on this list. It is simply too large for its own good. The telecom market is so saturated that it's tough to see how Verizon can grow its business any faster than the U.S. economy itself. This is shown by its recent dividend increase of only 2%, far below inflation levels, meaning those receiving dividend checks from Verizon are steadily losing their purchasing power. Verizon's share price is essentially flat the last 10 years, only returning 0.9% per annum. Glancing quickly at their metrics, they are declining across the board from ROIC to their gross and operating margins. A stagnant business that is a value trap in my view, and not even the dividend is attractive enough to make this stock worth holding. And finally, the worst stock in the Dow Jones Industrial is pharmacy retail giant Walgreens. Walgreens is a business in an industry disrupted right now, and one wonders if they will really be there 10 to 15 years from now. A tragic story for the once mighty dividend aristocrat. It's the uncertainty of the retail industry in general that makes Walgreens last on my list. And their returns certainly reflect that. They are down 36.8% year to date, and annualized 10-year return is 5.9%. This article from The Street asks, is Walgreens so bad it's a buy? Shares slumped on Friday after the company and its CEO agreed to part ways. The pharmacy giant faces huge challenges. Yes, the stock is cheap, but letting it settle first may be a good idea, and this only happened 1 month ago. Step into any Walgreens and you'll see right away that customers are hard to come by. They are also dealing with the same type of theft problems as a Nike and other retail businesses. Brewer's 2-year tenure suggests the company is dealing with too many problems and many mistakes, some of which predate Brewer and will take months, if not years, to resolve. The biggest challenge is that the pharmacy chains have been gobbling one another up in recent years. At the same time, they've been trying to transform themselves into healthcare companies where they provide physician and nursing care along with prescriptions. Walgreens is the majority owner of Village MD, a network of primary care clinics. That tells me they're transitioning out of the retail business and into healthcare, which makes this a risky play because any restructuring like that will take time to bear fruit. A treacherous market. Walgreens faces an extremely intense and complex competitive landscape. The classic pharmacies compete against themselves and also against the likes of Walmart, Costco, and grocery giant Kroger, online pharmacies, and pharmacy benefit managers that act as middlemen between insurance companies, pharmacies, and drug companies. This is where things get complex. CVS Health owns CVS Caremark thanks to its $68 billion merger with Aetna in 2018. Rite Aid owns EnvironRx, and health insurance giant United Health Group operates Optum Rx. Right now, in my view, there is far too much uncertainty in the pharmacy industry and retail industry in general to make Walgreens even worth considering as a buy. That wraps up my rankings of the 5 worst stocks in the Dow. Thank you for watching, and what do you think? Are my rankings spot on? Am I absolutely crazy? Let me know by commenting below, and if you haven't done so already, hit that like button for this amazing video and subscribe to the channel. Also, hit that notification bell so you can know when I post more content just for you. Thank you, and happy investing.